Hey everyone, welcome back to Fiscal Voyage. I'm Felix. In today's video, we're going to talk about a new stock that I purchased. This stock had a earnings report and dropped over 17% in one day. So I decided to buy, first I looked into the earnings report, see what happened, and I decided to buy shares of this company. And basically they, lower expectation for the year. And that's what kind of drove the price to drop around 17%. So first we're going to look at my Interactive Broker account, and the stock that I bought is STZ, ticker symbol STZ. You can see here I bought 12 shares, so it's about around $2,000, 2,200, 2,100 something of shares, and 178.77. So I'm up because I had a nice day yesterday, so I'm up around 3 or 4% right now, but we'll see what happens. And I show you why I bought shares of this company at that price, and why I bought it fundamentally and technically. So let's get started. Well, first off, we're gonna go to Fast Graph, remove the price, and you can see here this stock has been very good, very consistent over the past 20 years. It has been growing for the most part every year. There's been some down years, 2020 negative 2% growth, negative 6% in 2013, and 2008 negative 14% growth there. But overall, you can see here they had a great year from 2014 to 2018, a 4-year run of high double-digit growth in earnings. But you can see here estimates are expecting a 12% growth year over year for fiscal year 2025. And you can see here they expected around 7-8% going forward. And why I bought it is, you can see here, is undervalued based on the Fast Graph. It has a PE ratio of 13.9, so 14 PE. Earnings yield over 7. I like to see this at 6.5 or higher, and it's higher. The yield is okay at 2%. Triple B rated credit rating, and the long-term debt to cap ratio at 53, which is pretty high, not substantial, but it's getting there, high range. But overall, this looks great. You can see here there's been times, great buying opportunity, of course, after 08 crash, where the stock had a valuation under 10, a PE ratio under 10. That was great buying opportunity. And during this time, it was growing earnings, at a double-digit rate, you can see here. And the next great opportunity was during COVID, when it went under the 15 multiple, and it went as low as multiple of 13. This one here is went as low as 178. As you saw what I purchased, it doesn't look like we get there, but it's around 14 PE multiple. And if we go back to the normal multiple at this current price, you can see here we can have around in the next few years 24% annual rate of return if it gets back to a normal multiple of 18, which is not expensive in a sense, right? That's kind of like fair. For a high growing company, it's a high single digit growth company. If we go to operating cash flow, is the dividend safe? Yes, in operating cash flow, the dividend is safe, very well covered. And if we go to free cash flow, is the dividend safe? Yes, the dividend is safe, it's covered as well from the free cash flow. And free cash flow is expected to grow, in a high double digit, or the double digit rate for the next few years. And if we go to EBITDA is growing as well, and is undervalued based on EBITDA as well. And we go to sales. This is important as well. Sales is expected to grow. You can see here on 4%, 6% in 2027. So sales is continues to grow. So overall, everything looks good for this company. We go to forecasting and go to long-term growth here. You can see here we could have, if it stays at a 15 multiple, a nice 11% annual rate of return for the next few years. We have 4 analysts watching this company, and that looks good. Now, if we go back to around that 18 multiple, we could have for the next few years 14 or 15% annual rate of return. So that looks great overall. And we go to analyst scorecard. We can see here analysts are pretty accurate with this stock, around 55% hit, or the company beats it around 45% in a 2-year, and the same thing for the 1 year. So overall, that looks good. I like it a lot. And now if we go to Morningstar here, Morningstar gives it a 5-star rating, which is a buy, a wide moat, a fair price of 291, so it's very undervalued based on Morningstar. I like that a lot. And we go to CFRA. CFRA has a price target 275. See here the price here 181. Has a 3-year projected earnings compound growth rate of 9%, which is really good. The yield here is, like I said, is around 2%. And here, 2025 expected earnings is higher than 2024. 2026 expected earnings higher than 2025. So that's earnings to continue to grow. Price follows earnings. So as long as earnings grow, price will follow earnings. And if we go fundamentally or technically, why I bought shares, and this because of the 3-month chart. And you can see here on the 3-month chart, it hit this 50 moving average right here. 50 moving average at 177. So I got it around 178. It got as low as 176.51, and I got it at 178. And you can see here right now the price is at 185.91 with a pre-market here 185.80. So it could bounce back all the way up to 240. That's a possibility, back to this moving average. And you can see here this kind of bouncing during COVID. It kind of bounced around that area, or $100 area, which is near this moving average, which is near. And if we go here, you can see here this 50 moving average is good bounce here. This is the '08 crash over here, and then it got higher, then it came down and bounced on the 3-month 50 moving average. So it's great buying opportunity there. So that's kind of why I bought shares. So we had fundamentally look good, and right on that moving average here on the 50, and that's why I bought shares. So the next level that I'm looking to buy more shares is right over here. You can see in this area right there, we got that support there. It broke during COVID, but it bounced right back up, and then we had another support here during this time frame of 2020 October. It got low as 160. So this is kind of the next area of support that I'm looking to buy more shares. And then we have this as well, kind of right there in this area here. So this whole area is where I will be buying more shares. So I bought shares because it looked undervalued. So there's always a possibility with the stock continue to go lower for whatever reason, but fundamentally it looked good right at the 3-month moving average. And this will be my next add position here on the $150 area, $160 area, all the way up to 140. I'll add more shares here, and then I wait and see to see what happens. But that's technically what I was looking at when I bought shares of this stock. And on the monthly chart, the monthly chart doesn't look good. You can see how it bounced in the moving average here, and kind of here, and then it broke the moving average. But there's a possibility there where a lot of times stocks likes to retest the moving average. So there's a possibility that will come back here to 30, but then it could drop, crash for whatever reason. We'll see what happens. But the monthly chart doesn't look too good. It has the potential to get back to the 150 all the way down to 120. Don't see that happening because that would be extremely undervalued, but maybe who knows what happens, right? And on the weekly doesn't look good, and you can see here on the daily how it was respecting this moving average here on the 50 on a daily, and it broke this. If we do here this bear flag right there, we did that, it broke it one day here, and then just crashed down. And then this is where that earnings report here, and it gapped from 217, opened up at 202, had a little spike all the way to 207, and then crashed all the way down to 179. And then the next day is where I bought it, around here, 178 or something like that, and is up nicely now. So we'll see what happens. I won't be buying more shares at this price, even though it's still undervalued. Like I said, I'll be looking at around that 160, 150 area is where I'll buy more shares. For now, I'm just gonna hold what I have and just watch the stock, for the next few months and see what happens until next earnings report. But as you can see here, everything looks good. Fast graph looks good. We're showing this time period here. You can see here, even if it stays at a multiple of 15, you can have a 14% annual rate of return, which is, real good annual rate of return. Now, if we revert back to a multiple of 20, where it's been at in recent years, 30%, 32% annual rate of return for the next few years. So that's great. So this is why I bought shares of this company, and this company has been growing dividends as well. You can see here. Let me extend this here. You can see here, there's been a year where it hasn't grown it, but it's been growing the dividend very nicely. The most recent, it was 11% increase. So I like that a lot. The payout ratio is low. So overall, it looks good. And that's why I bought this stock. Make sure, if you're new to the channel, make sure you hit that subscribe button. And if you like the video, hit that like button for more videos like this. And I'll see you guys in the next one. And let me know as well on the comments what other stock you're buying, what you're interested in, what would you like me to review. Thank you, and I'll see you guys in the next one.